Yo, what's going on, guys? Bexio back, and today we get a brand new video. This time sticking to the subject of the stock market, and as you can tell by the title of this video, why you shouldn't be selling your stocks right now. And we're going to break down all these numbers to try and show you guys what is actually happening and what selling your stocks could do if you plan on, buying back in and trying to time the market and stuff. We're going to just review everything and throw these numbers at you. So I actually had a different video that I was thinking about making, still based on the stock market and stuff, but I saw a video from Andre Jick. I hope I said his name right, but that guy, I watch him and, his investment stuff, and he does a different type of investing than other people that I watch and that what I do myself as of right now. But so it's good to see like a different perspective, and it's good to see, just a bunch of different views on the market, as well as, so there's him, Graham Stephan, and Meet Kevin are kind of like those three guys that I, watch on YouTube. Look through like their stuff, what they think is going on in the market compared to what I think is going on, how they mesh up and how they compare, and how they differ, and make sure you can get both sides and both like opinions and stuff of everybody to make a better decision for yourself. But the one thing that was in Andre's video was he talked about over a 20-year period what would happen if you missed the 10 best trading days, the month's best trading month, and the best trading 2 months within a 20-year period of trading on the stock market. So basically, if you could see, if you put $10,000 in the stock market for 20 years and let it ride out, it would turn into $30,000 on average, considering the average growth rate and stuff like that. It would turn into $30,000. But if you took that same $10,000 and took it and missed only the 10 best trading days of 20 years, over an entire 20-year period, if you missed the 10 best days, that would leave you with half of your profits. Instead of $30,000, that would now be worth $15,000. And now compare that to the next type of shift so now we know if you just let it sit in there and ignore it through the highs and lows, on average it'll turn out to $30,000. If you take that same 10, miss the 10 best trading days of 20 years, it's going to come out to $15,000. It's going to be cut in half, your profits. Now if you take that same $10,000 and you miss the best month of trading over a 20-year period, it's going to come out to being only worth $6,000. So you're actually going to take a loss by missing only the best month out of 20 years in trading the stock market. So it should be shocking to a lot of people, and kind of a wake-up call to why you should let your money ride it out. These are low times and they suck, but selling it and trying to time your way back into the market is not the answer. But finally, for the last little comparison, if you take that $10,000 and you miss the 2 months of best trading over a 20-year period, that $10,000, you would be left with $2,000. You would lose 80% of your money because of trying to pull out and put back into the market and time the market and, take the losses once it goes down to protect yourself, and then buy back in at times where it's going back up, where you've already missed, the recovery days. You already missed the high percentage days, those types of days that are the ones that are going to affect your profit the most. So a big thing to take away from this is seeing, obviously, letting your money ride through the ups and lows is always the best way to do it. And the best way to make sure you can handle that is to only have money invested that you don't need in the short term. So obviously, if you need this money within a year, if you need this money within a few months, if you need this money tomorrow, you should not be investing it. You should be holding it in cash, probably in a high interest yield saving account, which right now they're not too high. They're not really high yielding right now. They're kind of like a basic bank account. But they should come back. But either way, you should have it in an account, in a bank account, in the high yield account, not in the market. So like we said, missing the 10 best days can cost you half your profit. And the problem with selling your investments and buying back in to try and protect losses can hurt you, because you're going to be looking at the market, and the best trading days typically come after some of the worst trading days. If you look back, there's about 6 out of the 10 best trading days are within 2 weeks of the worst trading days. So if you're trying to time the market, you're probably going to miss your chance to buy back in and ride the wave up. Whereas if you just let it ride out, maybe it would go down lower, but if you don't need that money, you should just let it go, and then it'll come back up in one of the best trading days, in the majority that come after some of the worst trading days. A situation I see people having to deal with, where if you want to protect your losses and you're selling your stock to buy back in, I'm just going to paint a little scenario here. Let's use Apple for today. I don't know the days, but let's just use Apple and use the price. We're going to say Apple opened the market at like 241. Obviously, these prices aren't right because this video is going to be going up later, but say Apple opened at 240. Let's say that. Say you sold because it's been going down and down, and you just assume it's going to go down even more. So you sell and say, I'm cutting my losses, I'll buy back in once it goes down lower to protect myself a little bit. Now, what happens when Apple starts to trend upwards? So at 240, let's say it goes down to 235, and all you think to yourself is, I made the right decision, I'm saving money, I'm not losing it, we're doing good now. And then a couple hours later, now Apple's at 245, and now what do? Do you question whether or not you should buy back in? Is it going up now? Are you going to wait for it to come back down and buy back in because you don't want to miss it going up? Now you're running into these questions that you don't have answers for, and that can cost you money and profits that you don't want to lose out on just because you want to protect losses on money that you don't need for multiple years. But going further on that point, if Apple was at, that 245 mark and you said, nah, we'll see what happens, and it goes to 255, are you going to buy back in then? Are you going to pay that premium? You sold at 240. Are you going to pay more to get back in now and try and ride it up only for it to, when you buy back in, if you buy back in and it comes back down to 240, are you going to sell again because you want to protect your losses? Are you going to hold on to it at that point, or are you going to just sit there and watch it, and then as the market recovers over the next few months, maybe a year, you look at the market and you see Apple slowly going up from 250, 260, 280, 300, and all you're doing is sitting there waiting for the next dip because you want to buy back in because you sold to protect yourself, whereas now if you just held at 240, you would be enjoying the ways up right now. But now you have to question yourself as to when you're going to buy back in, or if you're going to wait for a dip. And if that dip never comes, then what do you do? So that's just the scenario that I see a lot of people getting stuck in. A lot of people trying to protect themselves from losses, being scared to lose, which is completely human nature. It is completely fine to think that way. Obviously, it's a lot easier to do this in practice, or in theory instead of practice. Whereas when you see your money going down, it's a lot harder to let it ride out. And it's easy to say this, but I'm doing this right now. I'm letting my money ride. I'm not selling anything. I'm continuing to buy in as normal, whereas these prices are pretty much premiums. They're good deals right now because of the stock market has been set back multiple years. It's like 4 or 5 years at this point from being torn down, tumbled down from where it was because of the issues going on. But guys, I just want to get that out there. I was going to make a different type of video structuring something else, but I think this is a very important point to get out there, and a very important thing for everyone to know is you should be looking towards the long term, especially if you're young, especially if you don't need this money right now. You should look towards the long term and just see this kind of as a blip in the timeline of your stocks, where yeah, it's going down, and it sucks to see it. And if you can't handle seeing it, I would say just don't look at your portfolio. Just don't look at your stocks. Just know that you have them. Know that they're probably going down. But as long as you don't look at it and don't panic, you can go back at it, a few months from now and assess it on its way up, so you can at least enjoy the recovery and the time trading up and making money again, so you don't have to deal with losing money. That would be what I would do. But guys, if you enjoyed this video, if you have anything that you are doing for your stocks or for your investments, make sure to leave it in the comments below. Tell me what your strategy is. Are you just hanging on for the long term like I am and like I've said in this video? Or are you doing something else? Don't forget to comment, rate, subscribe. Also, everyone. See you guys in my next video.